Coinbase is building an unstoppable everything exchange. They are rapidly transforming from a simple crypto broker right into the foundational infrastructure of the digital asset economy. But here's the catch, and this is exactly why the market is sweating right now. Their most reliable cash cow is currently trapped in a massive, high-stakes standoff. Coinbase's wildly ambitious long-term future is on a direct collision course with a severe immediate threat to its profitability. $292 million. That is exactly what Coinbase pulled in from stablecoin revenue in just the second quarter of 2026 alone. Through their strategic partnership with Circle, Coinbase co-manages USDC, and they earn interest income on the massive fiat reserves backing it. This income stream, it's become a totally critical pillar of their entire business. The problem is, decentralized rivals have caught on to just how lucrative this setup is, and they are actively threatening to squeeze this crucial revenue engine all the way to zero.
JP Morgan analysts are calling this dynamic a classic prisoner's dilemma for Coinbase and Circle. And the proof is already out there. To defend USDC's distribution and market share against other yield-bearing alternatives, Coinbase was forced into a brutal revenue-sharing agreement with the decentralized perpetuals exchange called Hyperliquid. Just to keep USDC on that platform, Coinbase handed over 90% of the reserve yield. 90%. So the ultimate question we have to answer in this explainer is, can Coinbase's transformation outpace the severe margin compression, or is the market right to be terrified? Let's get right into the numbers.
To really grasp what's at stake, we have to look at how this business actually operates today, because it has completely moved away from relying solely on highly cyclical retail spot trading. If your mental model of Coinbase is still just an app where retail investors buy and hold Bitcoin, you are missing the fundamental economic engine of the company. Today, Coinbase operates as a true everything exchange. We're talking integrated spot trading, perpetual derivatives, which let traders bet on future prices with no expiration date, stock trading, prediction markets, and even their own proprietary scaling networks. Their client base is a massive mix of retail consumers, heavy-hitting institutional clients using Coinbase Prime for execution and cold storage custody, and developers building decentralized apps.
You can actually see this transformation perfectly in their Q2 2026 revenue mix. It is almost a perfect 50-50 split. 49% of revenue came from transaction fees, while 48%, a staggering $555.1 million, came directly from subscriptions and services. This services segment acts as a vital buffer against the infamous wild volatility of the crypto market. And here's the kicker. Spot Bitcoin trading dropped to just 12% of total revenue in Q2.
But if you want to understand their true underlying moat, we have to look a layer deeper. The real competitive barrier here is Base Chain. This is a proprietary Layer 2 network where Coinbase essentially acts as the toll collector, or sequencer. And this network has become the premier platform for agentic finance. That's a rapidly growing space where AI agents autonomously use Coinbase's X402 payment protocol to settle transactions. The total addressable market here is just staggering, with projections pointing to a $16 trillion real-world asset market by 2030. When you combine that potential with the fact that Coinbase acts as the primary qualified custodian for the vast majority of US spot ETF issuers, you end up with a deeply sticky gateway that locks in client assets for the long haul.
So if this strategic moat is so deep and wide, why these sudden market panic? Let's shift gears to July 30th, 2026, when Coinbase reported its second quarter financial results. This exact moment sets up a really stark contrast between Coinbase's strategic long-term wins and the immediate top-line misses that completely spooked Wall Street. Let's analyze the hard evidence from Q2. Total revenue came in at $1.22 billion. That was a 14% sequential decline, missing Wall Street consensus by over 11%. But the bottom line is what really sent shockwaves through the market. They reported a GAAP net loss of $359.5 million, which translates to an earnings per share of negative $1.36. That missed the consensus estimate of a mere 1 cent loss by an absolute mile. Now, it is absolutely crucial to point out that this massive EPS miss was heavily driven by a $209.5 million non-cash mark-to-market loss. That means it was a paper loss driven by crypto price swings, not actual cash walking out the door, combined with some restructuring costs. But you have to contrast that brutal bottom line against the incredibly bullish fact that their global trading market share actually hit an all-time high of 10.3%. They are actively gaining ground, even as overall trading volumes slow down. However, the market rarely forgives a miss of that magnitude, and the reaction was swift and brutal. Shares plummeted 6.53% in after-hours trading, dropping straight to $152.90.
Analysts are clearly terrified about two main things right now: slower trading volumes across the board and that compressed USDC economics issue we discussed at the top of the explainer. Wall Street analysts immediately slashed their price targets. Citigroup cut their target from $400 all the way down to $235. JP Morgan cut to $196. Barclays maintained an underweight rating with a price target of just $99, explicitly citing persistent margin headwinds. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed, because the contrast happening beneath the surface here is genuinely fascinating. On one side of the business, you have intense retail headwinds. Platforms like Robinhood are expanding their spot offerings with lower fee models, which puts a ton of pressure on Coinbase's premium retail take rates, especially when market volatility is low. But on the exact opposite side, you have an unbreakable grip on institutional dominance. Coinbase's absolute compliance-first strategy has concentrated global digital asset custody directly onto their balance sheet. They are the trusted intermediary for the biggest, most cautious financial institutions in the world.
So how do we actually objectively measure the health of a business caught in this crazy tug-of-war? We need to run this through a qualitative business scorecard. And honestly, this is the perfect moment to seamlessly introduce the platform that powered the incredibly deep analysis for this explainer.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, quality businesses built to compound for years, hidden gems, under-the-radar names with asymmetric upside, and dividend hunters, durable income with the fundamentals to back it up. You also get Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of your screen. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Let's synthesize the qualitative scorecard generated by that research. Financial health gets a massive 9 out of 10. They have an $8.6 billion liquidity fortress sitting in cash and short-duration assets, making their balance sheet incredibly resilient against shocks. Market position gets an 8 out of 10, largely due to that consolidated institutional custody we just talked about. But look at management alignment, it's a 7 out of 10. While CEO Brian Armstrong does have a massive $14 billion equity stake that aligns him with shareholders, this is somewhat offset by active insider selling through pre-planned 10b5-1 trading programs. In fact, Armstrong sold over 1.5 million shares, equivalent to about $550 million, between April 2025 and January 2026. Finally, profitability sits at a 6 out of 10. Yes, they've delivered 14 consecutive quarters of positive adjusted EBITDA, which is their core operational cash flow. But as we saw with that Q2 net loss, their official GAAP accounting profitability remains highly volatile and tightly linked to crypto asset valuations.
The crucial piece of the puzzle now is figuring out where this all goes over the next 5 years. Before we break down these numbers, I need to state clearly, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. What we are doing here is mapping potential trajectories using a baseline share price of $152.90, which is the level established right after that Q2 earnings drop.
Let's walk through the operational assumptions driving these numbers. The bear case assumes this on-chain prisoner's dilemma escalates. Yield economics erode as more exchanges demand those 90% splits, retail trading volumes migrate to low-fee rivals, and heavy stock issuance dilutes the shareholders. Under this scenario, revenue drops to $5 billion, margins collapse to 5%, and a 15x multiple implies a brutal price of just $13.39. The base case, however, assumes the everything exchange strategy actually works. Revenue hits $10 billion, stablecoin yields remain profitable despite making some moderate concessions, and margins stabilize around 18%. Given a 25x multiple as a premium fintech infrastructure play, we get an implied price of $176.47. The bull case is where things get truly wild. This assumes uncontested domination in agentic finance. The X402 protocol becomes the global standard, driving exponential fee growth. Revenue scales to $18 billion, margins hit 30%, and a 35x multiple implies a share price of $787.50. If you want to access the full model with all the detailed assumptions behind each of these scenarios, you can check out the detailed research report over at flashstocksentinel.ai. When you lay out these scenarios side by side, the asymmetry of this setup becomes glaringly obvious. By applying a probability weighting, 50% for the base case, 30% for the low case, and 20% for the high case, we calculate a blended target price of $249.75. If the base and bull cases hold together, this represents a highly asymmetric 10.31% annualized return over the 5-year period. The downside risk is definitely severe, but the upside potential drastically skews the math in a fascinating way.
Let's drill specifically into the base case and see exactly what has to happen operationally for that 50% probability target of $176.47 to actually materialize. It assumes a 7% compound annual growth rate in revenue. It requires stablecoin yields to remain highly profitable, meaning Coinbase makes some moderate sharing concessions but doesn't get totally squeezed out of the market. But perhaps most crucially, they have to aggressively utilize their $2 billion share repurchase authorization. Right now, stock-based compensation represents approximately 14% of their revenue. That is heavy dilution, and active buybacks are absolutely essential here to offset it and protect their earnings per share.
Now, let's pivot aggressively into the risk analysis. We need to move way past the generic boilerplate risks and look at what could legitimately break this investment thesis. Because make no mistake, the threats to Coinbase are deeply structural.
Here are the concrete structural threats you have to watch. Number 1, yield contagion. That hyperliquid deal we discussed, if other major blockchain networks start demanding that exact same 90% yield split just to distribute USDC, Coinbase's high-margin interest income could absolutely crater. Number 2, fee compression. Asset managers running ultra-competitive, low-cost spot ETFs have massive bargaining power right now. They could squeeze Coinbase to lower its lucrative custody fees over time. Number 3 is pure execution risk. Their push for AI-driven code generation has increased deployment speed by 2.2 times. That rapid velocity risks introducing latent vulnerabilities or system instability right into their core transaction interfaces. And lastly, international compliance. While domestic regulatory pressure has eased slightly, their international operations still face some serious heat, highlighted by a £3.5 million fine from the UK's Financial Conduct Authority for customer onboarding failures.
So, what are the actionable early warning signs investors need to monitor? Within 1 month, watch for a sequential decline in monthly transacting users. That's a clear sign that retail is fleeing. Looking out 3 months, keep an eye on a contraction in the total circulating supply of USDC. But the ultimate 6-month red flag? If major centralized venues start refusing standard distribution agreements and demand greater than 90% yield pass-through, if that happens, the margin decay is accelerating and the prisoner's dilemma is actively being lost.
Let's bring this narrative full circle and deliver the final verdict on Coinbase. We open this explainer by highlighting the massive tension between their visionary infrastructure build-out and the very immediate threat to their $292 million stablecoin cash cow.
Here are the 3 absolute most important takeaways you need to weigh. First, yield compression versus diversification. Yes, the structural stablecoin threat is very real, but they are successfully diversifying into subscriptions, derivatives, and prediction markets. Second, the massive upside hinges entirely on monetizing the base Layer 2 network. Collecting those sequencer fees from automated AI agents using the X402 protocol is the key to decoupling from spot volume entirely. And third, the regulatory catalyst, the impending Bipartisan Clarity Act in the US, which would establish a clear federal framework and massively reduce their compliance costs moving forward.
Which brings us right back to the final question: can the everything exchange outrun the stablecoin yield compression? The reality is, Coinbase is no longer just a Bitcoin casino. It is transformed into a premium infrastructure proxy for the entire digital asset economy. But its current valuation and its ability to fund its wildly ambitious future relies entirely on surviving the prisoner's dilemma in the present. The one key thing to watch next is whether that 90% revenue share deal becomes the new industry standard or if it remains a one-off exception. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.